Day trading crypto and making investment returns in the biggest opportunity of our lifetime. You and I both know that there's going to be nothing bigger than this. This is the trade of our generation, crypto, monetizing, growing, and us being a part of that. So in this video, I'm going to go through how to actually make investment returns in crypto, how to trade crypto, and how to think about risk, because risk is everything. There is no emotion when trading or investing. You just pick assets with volatility and return profiles. I'm going to give you all of the information here, how to go ahead and do it, and how to take the amount of risk that you want. The base level return that you should be benchmarking here over the next 12 years is 600%. That is what you should be making on your money. Now, I went to Grok. I used to do these calculations manually, but it's great that we have AI these days. Bitcoin is going to have a 40% ARR, annual rate of return, for the next 4 years. Then it's going to go down to 30, and then it's going to go down to 20. Now, if I invest $500 per month for all 12 years, how much would I make? 6x, 600%, $412,000 as an investment return, plus the $72,000 that we put in. That is the base level. Doesn't matter about the nominal dollar amounts, it's the percentages. 6x, 600% is the benchmark to outperform. Now, I'll show you exactly the ways to trade, how to take more risk, how to time cycles if you want to do that, to outperform that 600%. The fundamental thing we have to know about markets before placing any trades is that we have periods of risk on and risk off. And those periods are dictated by the central bank, mostly the Fed, that controls pretty much everything, and other central banks kind of play off of the Fed. But they will control risk on and risk off because they control the amount of fiat currency and they control the cost of that fiat currency through the interest rate. That controls everything, risk on and risk off. Now that we know that, we can take advantage of those cycles. It's exactly the same. I trade crypto now, but I traded stocks before. I was employed on the London Stock Exchange by a couple of different firms. Stocks and crypto, they behave in the same way, right? Risk on and risk off. So we can go ahead and take advantage of those cycles. Why I said 600% is your benchmark. This is Bitcoin compound annual growth rate. If you just invest every week, your compound annual growth rate is around 50% a year. For Ethereum, it is right now 60%. They're the benchmarks that we're going off. Now we can try and trade cycles if we want to try and outperform. We can try and take a little bit more risk if we want to outperform. Now what happens is that those cycles create the typical cycle, which is for risk on. And this is really what happens. Bitcoin tends to outperform during the first stages of a bull market. Bitcoin will be invested in, it gets big flows. That's the alpha, that's the benchmark of crypto. Now, as the bull market matures, people go what's called up the risk curve or out the risk curve. They start to invest in riskier, smaller stuff. People start to make money in BTC, that wealth effect comes in, people feel confident, etc. This is a classic cycle. You move out the risk curve, moving down the list, right, to alt L1s, ETH, Solana, etc., maybe some other tokens that will come around in time. You move out to app tokens, you move out to DeFi, and then NFTs and memes, right? It doesn't matter about the name or the logo or anything else. There are certain assets that have certain volatility and risk. We can just expose ourselves to the exact amount of volatility and risk that we want to take advantage of cycles. It's as simple as that. There's no emotion in this. You can see this as well. This is Bitcoin dominance. So usually what happens is Bitcoin dominance rises during the bear market and into the bull market. And then during the latter stages of a bull market, you may tend to see altcoins outperforming. So Bitcoin dominance falls, but altcoins outperform a little bit. Again, you don't have to trade that because Bitcoin has 50% CAGR. But if you're looking to outperform that 6x over 12 years, then you have to be a little bit more active around the market. You can trade altcoins if you want because they have extra volatility and risk, or I'll show you, you can day trade Bitcoin. You can day trade Bitcoin, take advantage of short-term price movements, and that actually tries to earn extra on top of BTC. Again, it's your choice, it's up to you. You can see this here as well, perfect. So we see two phases. There is a Bitcoin phase, phase one, where Bitcoin starts to go up, recover out of a bear market, move up, have great returns. Altcoins tend not to do much during that cycle. Phase two is when you move up, Bitcoin is still performing, but altcoins, that's alt season. That's when everyone gets excited, pours into risk, pushes those up. That is a double-edged sword. The first one is altcoins are going up in price, and that's great. So if we're in them and we know these cycles exist, that's good. But the other side of that is that if you are buying altcoins during this time, these are very, very highly valued, and usually you get a bear market after. So you have to be cognizant of these cycles and know exactly what we're doing to take advantage of them and not be on the wrong side of the trade and get wrecked. Now I'll show you the slightly laborious task of getting set up with a wallet for the first time. So there's two things really here. The first one is getting set up with a centralized exchange so you can move money in and out. The second thing is if you want to trade on decentralized exchanges and use dApps, then you need a wallet, right? And so you on-ramp into the centralized exchange, and out of the centralized exchange, you move those assets into your wallet that you want to trade. So what I'll do is I'll leave some tutorial videos on centralized exchanges that I use down in the description below, step by step on getting set up, getting money in and out. So you can use those. And Rabby wallet and the other wallets, I'll leave tutorials on those as well, so you can see exactly all of the inner workings. For this video, just a brief overview. So what we'll do is go to download Rabby. Now I'm using Rabby because it's an Ethereum wallet. If you're using Solana, Phantom wallet is great, or MetaMask or any others, Trust wallet is great. So you can choose, they're all the same really, which is just an interface to interact with the blockchain. So go and download the wallet and it's gonna set up a new wallet for you and it's gonna give you 12 words. Those 12 words are your wallet. So don't misplace them. If your computer blows up or your phone goes missing, you take those 12 words, you reload them in the app, download the app, reload wallet, those 12 words, all your money's still there. What I would suggest is a HODL wallet and a trading wallet. HODL wallet, send money in, send money out. That's it. Never attach to any dApp, never interact with anything. That's that. For trading, you want to make sure that that's your trading wallet that you're connecting to dApps. If anything goes wrong, that's a small part of your portfolio that, it can go wrong with, right? But the HODL wallet is just as it is. I'll leave videos below on that as well. Best practices and hardware wallets and if you should use them, right? So this isn't for the faint-hearted for sure. In any case, we're into the wallet and I've got my wallet address right here at the top. So I'm going to press copy. That's my wallet address. Now I'm going to send in some assets that I can go ahead and use DeFi. So what I'm going to do is go over to crypto.com. This is my on-ramp. So what we're going to do is go to home. We're going to press deposit, Fiat, USD, and this is the bank details. So I'm going to send in USD bank details there and send in the dollars. Now, any other fiat currency in your region, what I'm going to do is switch that into two assets. One is the layer 1 coin to pay for gas, which is Ethereum in my case. I'm going to be using Ethereum layer 2s, which are way cheaper. Basically trading on Apex or others is basically almost free when using layer 2s. And we need a stable coin. This is what I'm going to trade against. Everything in crypto is traded against a stable coin like USDC or USDT. So those two things I need in my wallet. It's actually a lot easier than it seems. I'm going to go to trade and we're going to buy. And we're going to press ETH, this one right here. Buy an amount of this. Now I don't need much of this because this is just for gas. So $10 or whatever is fine. So buy down at the bottom, ETH, and then the stable coin, something like USDT right here. And I can go ahead and buy that. And an amount here that I can put in and press buy down at the bottom. You can use your cash to buy. So I've got two assets. I've got USDT and I've got ETH. Now I want to send both of those to my wallet address that I just copied. So I'm going to press accounts, crypto wallet, transfer, withdraw. It's the same for every account, right? So deposit fiat, trade into the assets that you want, withdraw them. So I'm going to press external wallet. Now what I want to do is make sure that I send this to the chain that I want to use it on. For me, I think Arbitrum is fine. So I'm just going to send to Arbitrum and it's all the same wallet address. So I'm going to press withdraw and you can choose the assets that you want to withdraw and the blockchain that you withdraw them on. So for me, if I press plus wallet address, let's try USDT. Just try Ethereum for now. And then you can see right here, the wallet networks that you can use, right? Polygon, Kronos, Arbitrum 1, Avalanche, Optimism, ZK Sync, right? So I'll just choose Arbitrum 1. Now, my wallet address I can put in. So crypto.com are going to send the assets over the Arbitrum 1 network into my wallet address for Rabby. And so I'm using Arbitrum 1 network. I'll show you one in a second, but that's fine. So I can get the Ethereum out there to pay for gas fees, transactions on the blockchain, and I can get the stablecoin out there as well. And that gives me the assets in my account that I can go ahead and use DeFi with. I'll leave links down below to crypto.com. You can get $50 as a deposit bonus there if you are new. Apex actually gives 5% fee discount and deposit bonuses as well. So I'll leave all the links to the exchanges I use and also the best exchanges for different regions. I'll leave all the information down in the description. Once we have assets in our wallet, we can connect that to any application. So if we want to just have stable coins, we can put that in DeFi if we want. We can trade them. We can swap them for any other coin on a DEX. This is a DEX, right? So what I'm going to do is actually go over to Apex Omni right here, press this, and this is going to take me in. Now, because this is a DEX, I can just connect my wallet. So I'm going to connect wallet here. I'm going to press Rabby, MetaMask, Rabby, same thing. It's going to say, do you want to connect? I'm going to say yes. I also have to sign the wallet or sign a request so that it proves that I own the wallet. This is just signing into the dApp essentially. You can see that here. This is no money or anything. There's no gas fees or anything. I'm just going to press sign, confirm, and that signs me into the DEX. Now I can trade on here. Now what we want to do is deposit some funds into the DEX. You see I've got some already. The way that this DEX works, because it's on ZK technology, all we have to do is just use the blockchain to transfer funds in, trade them, and then when we want to transfer out, we transfer them out to the blockchain. So every transaction isn't actually paying for a transaction here. So what we're going to do is press deposit. I'm going to deposit here, and like I said, Arbitrum 1 is the blockchain that I'm using because it's way cheaper than the Ethereum mainnet. You can use any of these to deposit funds into the DEX. So I'm going to use Arbitrum 1 because I sent some money over to Arbitrum 1 from mycrypto.com, USDT. You can choose either USDT or C, as you can see here. So whichever one that you want to use, press the max amount, whatever that may be, and then go ahead and press confirm deposit. Now that requires one transaction from the blockchain into the dApp. And so that requires ETH for gas. On Arbitrum 1, it's going to be like 3 cents or something like that, tiny. But that transfers in your USDT or USDC. So you can press max here, USDC. So I've got $200. So you can go ahead. What I'd have to do is enable USDC first. So press this. I'm going to sign that transaction, confirm. That is like literally not even a penny. So once that's confirmed, I can then confirm the deposit. And I can sign that and send it in. So that's 1 cent. So that sends in the USDC into the dApp. Now I have that to go ahead and trade with. From here, I don't need any other blockchain transactions, and I have that in my dApp account. If you go to dashboard and then profile, overview, you should see the money in your account, right? So I've got some assets right here in my funding account. That's my funding account where the assets go and they just sit there. If you want to go ahead and trade them, you can trade futures or perpetuals, which a lot of people trade in their day trading, or you can trade spot as well. That is where you're just cash settling the asset. So there's no leverage, there's no anything like that. You just trade spot and you're buying and selling the assets, and the price movement is a price movement. A lot of people, when they trade, also trade futures because they can take leverage, they can trade short term. That's for more active trading if you want to do that. And then if you don't, you just trade spot, which is $1,000 in. That's your asset, right? You can, sell it and the $1,000 out, whatever the profit and loss is. With futures, I'll explain that in a second. So you can transfer and funding to either one of these, right? Perpetual account, right? Put $100 in or whatever it is, transfer. Now again, that's an internal transfer, so it's not a blockchain transaction. We can go ahead and use that. You can see that moved into my perp account to go ahead and trade. So that is getting money into dApps or in your own wallet, so you can use DeFi. Now I want to talk about portfolio construction and the amount of risk that you want to take. So what I would say is that benchmark at the start of this video, 600%, that's what we want to gain exposure to. That is the basis, the granite that we build our portfolio on and our risk taking on. We don't want to muck that up, right? We don't want to miss out on this opportunity. So have your assets that you want to invest in. Bitcoin has to be in there. For me, I think it has to be the biggest of what you're investing in, right? It's a massive worldwide institutional asset, right? It's very, very clearly successful. So we want to build off that, have that as our base. That gives us strength. If we're coming to the market with $1,000 of USDT and we don't have any assets and we're just trying to trade and make money, that's not a strong position to come into. We're going to make mistakes. We're going to try and make it. We're going to take risk where we shouldn't. So that basis, that granite, right? Have the assets there and just let them perform. That's it. Now we can move to risk. There's two ways to take risk. What we mean when taking risk is that we want to outperform that benchmark. We want to outperform 600%, right? That's why we trade. Now, if you don't want to outperform that, which you don't have to, just buy Bitcoin, right? 600% or a couple of other coins that you want. So that's the granite. From there, if we try and outperform that, which can happen, there's two ways to do it. The first one is to trade cycles and trade price movements. And we're day trading the cycle, right? The second way to do that is to buy assets that have way higher risk and volatility than BTC. That's why people buy memes or NFTs or go out the risk curve, right? That's two ways to do exactly the same thing. So it's up to you what you want to do, right? If you want to get into smaller coins, altcoins that can move very quick, I understand that. And so you can just buy those, right? And you're hoping to outperform the BTC during a cycle. Or what a lot of people do when they day trade, right? For me as well, is why don't you just stick to the big assets, really understand them, and then trade the price over the short term? Because there are opportunities within the price movements that we can actually use to outperform the returns over a cycle. So what I would say is split this up. Do you want it 90-10? Do you want it 80-20? That's up to you. I would suggest a bigger proportion than you would probably think in just investing in the asset and letting the outperformance come. So from there, choose whatever you want to do. And for your trading portfolio, you can take risk there. That section, that is what you trade. This can be any amount of money, a percentage of your portfolio. From there, we can take trades like this. We can choose the exact amount of risk that we want to take in those trades, the risk, the reward that we think. It's very, very simple. We know how assets move with their volatility as well. So that is how I would do it. Have investment, have your trading portfolio. In that trading portfolio, either buy assets that you think are more risky and more volatile that you want to make money on throughout a bull cycle, right? And know that you have to trade those, or you just trade the assets that you have and you're trading price movements, which is also another strategy. So they're the two strategies we can implement. Whether you're simply trading the price of the big assets or you're looking to buy into smaller assets because you think they're more volatile, it's actually the same thing because, like I said, volatility and risk profiles, price movements, everything goes off Bitcoin. If Bitcoin surges up, then after a little while, you're going to get those altcoins or some smaller coins outperforming as well. And so it's really Bitcoin that gives us the knowledge of how to actually go ahead and trade. So what I want to focus on here is how Bitcoin moves and how we can take advantage of this. Now, we all know about the 4-year cycles, right? These aren't Bitcoin cycles. These are central bank cycles, like I said. So you have risk on, you have risk off, you have risk on, and you're going to have risk off again. You can see it plays out, risk on, risk off, right? So you can see them moving. So we know that during a risk on cycle, we get price discovery upwards, we get volatility to the downside. This is what we can trade if we want to try and outperform 600%. So what we can do is go ahead and see how Bitcoin moves. This on-chain data is amazing. I'll link this below as well. It's free of charge. Go and look at this chart. Bitcoin basically, during bull markets, moves up and then retraces, move up and then retraces. We know that for on-chain data is showing us that those retraces are about 30%. You can see that here. So during a bull market, you get drawdowns. It's very easy to see these cycles. Now, this is on TradingView. This is my own chart here. I use this in the crypto investor course. People have asked for it. This is my own drawing, so I can't really share it in any way. But we have these 4-year cycles. We have risk on and risk off, like I showed you, right? So go to TradingView, look at the long-term Bitcoin chart, go down to the bottom, click logarithmic. That puts this chart on like this. And it's very easy to plot the cycles. This is halvings, these blue lines, and then just a mid fit, an up and a lower fit as well to the trend. And it's very easy to see where Bitcoin moves in these cycles. So we're in a bull market. You can see that we're in a recovery right now as making this video, right? Which means we may go up to the top of the range. We're in a bull market, right? So risk on. So we know risk on, we know prices are moving up. So what do we want to do? We want to go long. We want to go long Bitcoin. We want to go long other assets that we think will outperform if we think any will outperform. Right, there have been a few and far between. So you make those. So we know we get these drawdowns in bull markets. That's tradable. It also gives us the opportunity to know that if we're in a trade, we may get drawn down on by a certain amount. So we know that. That means we can trade and make sure that we give our trade the room that it needs. So really, what we want to do is enter trades where the price is at a pretty decent level. So we can go ahead, and we know that 30% drawdowns happen. In fact, in this bull market, there have been very few drawdowns. There's been a couple right here that went to about, 25%, 27%. They have been great opportunities. Let's look at this, 27% drawdown here. Go over to the chart. That was this right here, this entire range. Now, how do you outperform? What you can do is buy these drawdowns in a bull market. So we know we're getting drawn down, and we're going to buy those drawdowns because during a bull market, you get these drawdowns that happen, and the price then moves back up into price discovery. You can see them all here. So in this bull market, we've had 5 opportunities to make a trade, get in, and then you see the price move upwards after. That one there, huge one here. That is how you can try to trade to make trading profits. So the first strategy we're going to go through is what's known as dip buying or DCA. The dip buying strategy is very simple, and it takes advantage of the price movements in bull markets, but also the asset class that we're trading. We're not trading Forex here. We don't trade it like that. This is an asset class that is growing over time. And so we're always reaching new highs, and we're having drawdowns into those highs, right? So the reason we wait for a dip is not to try and get a better price for the entry. That is irrelevant in this asset class. This asset class is growing. So you buy, and you buy highs, and you keep buying highs because it's growing. Now, when you're trading and day trading short term, that's a little bit different because now we're into the scenario of we actually want to trade shorter term, which is we're much more sensitive about drawdowns, right? So the reason why we wait for these dips is because you can see the usual pullback within an uptrend is around 30%. You got a few big ones here, right? You can see a big one here. This bull market has been actually very tame, although we may get a big one, right? 50% drawdown. As you go higher, the odds of getting a drawdown obviously go up a little bit. But we wait for these drawdowns to enter short-term trades because we're just playing the odds. The odds are that if you get in at a 20 to 30% drawdown, that the odds of that actually going way lower by 50% start to diminish, right? In a bull market, right? These drawdowns, as you can see, they're actually getting lower over time. You had the pandemic here, you had the China mining ban here, which wipes everyone out. So they're going to be losing trades if you're in them, right? However, if you waited for a 30% drawdown here and you had 2x leverage and you could withstand another 50% drawdown, you'd actually stay in the trade and you went to an all-time high, right? So that's what I'm saying. It's playing the odds. When you're trading short term, it's playing the odds, which is why dip buying is something that we can do. It's otherwise known as DCA or dollar cost average strategy. Don't get it mixed up with just buying every week. That's known as dollar cost averaging as well. But this dip buying, which I'll show you, is a way to actually come into a dip, not just trade once, but trade a few times. Then we get an entry. And then we can know what's the average drawdown that we get, and we can then use our leverage. So what we're going to do is go over to the chart right here. These are areas where we get those consolidations or pullbacks. So this entire bull market, right? We have one here, we have 2, 3, 4, and 5 so far. 5 trades, 5 entries that we could possibly have. Now, I know this video is about day trading. We are not trading Forex. Crypto does not trade like Forex. All of the stuff you see, and a lot of the crypto stuff that I see, have been, being a trader for my whole entire adult life. A lot of the stuff that people are telling you is coming from the Forex world. They watch Forex videos, little ticks and this and that. That is not how this asset class trades. Currencies are not assets. They are liabilities. They're garbage. They move like a little bit. It's nonsense. This is an asset class that is growing over time. The best thing you can do is go long, be in the asset, right? And when we trade shorter term, what we're looking for is these huge moves to the upside to make sure essentially that our drawdowns aren't going to wreck our trades. So we want to be in. We want to be in for the bull market. What currency has bull markets like this? None. So we can't use FX style trading. We want to be in the asset. We want to make sure that these drawdowns, when they occur, we are active in those and make sure the only thing is that we don't get wrecked in the trades. But we will get wrecked in some, of course, which is why the short-term trading part of our portfolio is always small. And we just dollar cost average the assets. The reason I say this is because if you had bought Bitcoin at any time in its history, your trade will be profitable and you'll have a 100% win rate. That is odds that I want to play. I do not care about taking a 20% profit in a trade up here and trying to tick this 20% in and out. Irrelevant. Know the asset that you're trading. We want to get into trades where we get these drawdowns in bull markets because that's what we can use for our trading portfolio. Now for this, if you're in a bull market where the asset is ranging like this, these short-term trades, we can actually make sure that we get a pretty decent win rate on these entries. We don't have to take profits on these entries either because taking profit on an entry in a bull market is cutting your profits short, right? So we know we're in a bull market. We know these bull markets last for actually about 3 years, right, from the lows. If you look at Bitcoin, it goes green, green, red, green, green, red, right? 3 years bull market, one big bear market. In a bull market, you stay in, you take your entries more, right? And you wait for the price. Now, when the price is up here, if you've entered into these 3 trades, you can keep running these trades. Why would you get out? You're in so much profit. Now you have a position of strength. If you'd got out of these trades like this right here, you're now out of those trades and you're chasing the market again. That is the difference in mentality that I've seen professionally and what I see a lot of content. People are trying to get in and out and tick and make a win. Totally how professionals do not trade like that. You go in again. As profits start to go up, you're actually getting de-risked and that gives you strength. So I'm not going to sit here and say, look for a 1 to 2 win rate and all that nonsense. That's Forex stuff. It doesn't work in crypto. Never has worked, never will work. This asset class is growing. Be long, get in, right, and make money from these movements. These drawdowns are something we can buy. Using the last drawdown as an example, I'll show you how I would enter trades here. So this is the drawdown, and we essentially double bottomed here. So we got support, right, which is obviously a very decent pattern within an uptrend, right, because it's showing that sellers are coming in and buyers are actually forcing the price higher at twice here. So that's decent. And this drawdown was enough in percentage terms for actually us to start to take notice. So from this high level down to the very low was a 33% drawdown, more or less. I would say anything around 15% would start to get me interested, right? So in this range right here, I would start to get interested and then I can take positions. So we don't have to take one position. We can think of the trade with multiple entries, 1, 2, or 3. I think that's kind of the max, right? The problem with 3 entries, if you put them lower by, let's say, 5% increments, right? Then if the drawdown is shallow, you're not going to get your 3rd trade done and you might be chasing again. To be honest, doesn't really matter that much. 2's maybe a good number where you enter once. If you get a decent drawdown, again, you enter again, right? And then you've got that 3rd one that if you do get another drawdown, you go in. If you don't, maybe you just buy at the same price you did initially, right? And then you can get the 3rds of the trade in, right? And that's your one trade amount, right? So if each trade is $1,000, maybe split it into $333 each, right? Something like that. It's up to the individual. That's how I would do it. Right? You don't have to think as one trade as one in, one out, right? I know day trading, Forex day trading, in and out within 10 minutes, doesn't work in crypto. It ranges for a while and then it moves, right? So you have to know the asset class that you're trading. So the big thing that we need to be aware of is if we're getting a decent entry price around this level, is what can the price draw down to in a kind of normal scenario? Because if you're trading with too much leverage or you're trading too tight, you're going to get wrecked. So we've seen the drawdowns are 30% or so, or like absolutely guaranteed. Well, that was a 30% drawdown. And we need to give the trade room to breathe so we don't get wrecked or anything like that. It's this area here that we're trading, right? So what I would suggest from here is that we could get drawn down another 30% from there, and we should make sure that we can actually stomach that drawdown. So our stop loss in a trade, when you're trading short term, especially if you're trading on leverage, you must have a stop loss at all times. This isn't dollar cost averaging. If you're dollar cost averaging, just buying once a week, getting your granite right in to build your base, then you just buy once a week in spot, hold it in your own wallet, right? That's it. Because you're gaining exposure to the asset class. With trading, especially with leverage, if you want to take that, and I can't recommend it, but if you are doing that, you must have a stop loss because you do get those occasions where something happens and the price literally wicks down and your trade's out. So you must have those stop losses in there. This level would be the stop loss. And that's important because if we know the stop loss, which would be around 40K, so you're getting in, let's say around 60, 65 here, and a stop loss at 40K. We now know our entry and our total risk. 60K in, more or less, 40K as the stop loss. Now we can go back to our trading system. We know our entry and our potential stop loss. Now we can calculate the size that we can go in and also the amount of leverage that we can take because we now know the total potential loss. And for our trades, so we have our trading portfolio. We know that of a bull market, you might get 7 to 10 trading opportunities. So you can split your trading portfolio up into those opportunities each cycle, right? So you got 2 to 3 years, 10 trading opportunities. Now you may say, I want to day trade. I'm sorry, that's not how the market works. The market doesn't care that you want to make money on a daily basis or open a trade at 9 a.m. and close it at 3 p.m. Market doesn't care. The market doesn't behave like that. You get 7 to 10 opportunities in these bull markets for Bitcoin, and that's that. And they're where you have to go in. And so you can split up your trading portfolio into 5, 6, 7 chunks, and then each of those you trade. And then of those 5 to 7 chunks, we would hope to get a pretty decent win rate for those trades because we're just playing the odds with the drawdowns. If we can stomach the drawdowns, then you can let the gains speak for themselves. So from here, what we're going to do is go to the left-hand side, long position. Let's say I get in at not the best price, but a decent entry price for this consolidation here. So I'm going to put it a little bit higher because I actually want to make sure that we're in not at a good price, but at an average price. And we know that the drawdown would take us to something like this, and that would be a stop loss, right? That's important because now we can work out how much risk we have and how much we want to actually put into the trade. Now, what is the take profit? A lot of people come to trading with the mindset of working, and so they want to get in and out of a trade within a certain period of time. They want to make that money, and that's great. Now, of course, with the trade, we have to take profit at some point, right? And of course, what I would do with any trading profits is roll them back into spot BTC and have that in my account and wait for the performance there as well. I wouldn't be rolling them back into dollars or anything like that, apart from to fund lifestyle if you need that. But the take profit, right? There is in a bull market, there's no real edge to taking profits early in a bull market. Again, if you go back to all the Forex videos, they're going to say, 1 to 2 risk reward or take profits at the next resistance level. All of that sounds very interesting, but once again, I've never seen a real professional trader trade like that. In a bull market, especially for crypto, because we're in a growing asset class, you get paid to be long. And the only thing we have to worry about is not getting wrecked when you get those big dumps down, right? That's the thing we need to worry about with crypto. We're not trading Forex here. That is where longer term analysis comes in. So for me, this is the longer term Bitcoin chart. I'm on the weekly chart here, but you can see it's a very long trend. For me, up here is an area where the market is, mature in the bull market. You're talking about something that was trading at 16K back in November 22, and it's now trading at 102, 104. And this is a trend that Bitcoin follows. So up here is really where I would be taking profits. Now, that is if you're looking to trade the cycle, like get in 7 to 10 trades, try and trade out somewhere near the mature end of the bull market. That is what I would suggest, right? And that is what I would do, because why take profits early if you think the thing goes higher? So what you can do is when the price gets up here, and we're fairly near it now, to be fair, you can start to think about what's the risk reward of actually getting into a new trade during a dip versus actually starting to come out of the trades and take profits. Because up here is not the time to be taking leveraged long positions, is it? Because this is the area where Bitcoin usually starts to falter and actually buyers start to get a bit exhausted, right? You can see that each and every time. The price is different each time, but the actual cycle and the way that the behavior works is the same each time. So up here is when you start to think, do I want to enter new positions or do I want to start taking profits? I do not see the point of trying to arbitrarily choose a profit like 50% profit or the previous all-time high. You can see here that if we had got into some decent trades here and thought, you know what, I'm going to take profits at the previous all-time high. Well, you just missed out on way more profit, right? That was a 140% trade versus a 250% trade. So why get out, right? You can de-risk a little bit, but if you're here in the cycle, that is not the peak of the cycle and you move higher usually. So that is how I think of it. There's no point trying to arbitrarily choose a profit level, a risk reward, get in and out of the trade. And, I want to make small profits. No, we're here to ride the trend and to get in decent levels and get out when the trend is over, when the risk reward is starting to look poor, right? At these levels, the risk reward is still good. So you're still going in. So that's how I would trade that. Coming to trading on leverage, it can be used in a crazy way and it can be used in a professional way as well. Now, I can't recommend leverage to anyone, and don't trade anything that's unsuitable for you. So leverage is not necessary. This asset class is growing. Buy spot, right? Hold it. But the way people use leverage is, in a professional sense, is to understand what their drawdown is, and then they can actually understand how much they can put in and how much leverage they can use. So if we enter this price, and I know that this drawdown here is around 35%, that tells me that I can use around 2 to 3x leverage on my trade without taking any more risk. So think of the trades that we have in, right? So we have 1 to 7 here, and each of those trades, you can put $1,000 down into the trade, for example, right? So each of those, you have $1,000 to risk, and you know that, let's say, 50% plus of the time you're actually going to make a good trade there. And a couple of the trades, maybe for some reason, it just goes wrong, whatever. We know that that's going to happen. We're going to lose some money there, but we think overall, we're going to make money out of those trades in the cycle. Using leverage, what I can do is put the amount in that trade. And essentially, if I know my stop loss here is 30% down, that means I can use just up to 3x leverage and take no more risk. Because if I use 3x leverage, my $1,000 in the trade here is the percentage moves are leveraged 3 times. Let's just call it 2x for simplicity. If I'm in here and I'm using 2x leverage, that means my drawdown can be 50%. Because 2x leverage means that it 2x's the percentage moves. So a 50% drawdown wipes out all of my money. Right? If I'm using 3x, then it's a 33.3% drawdown, more or less, right? And that is multiplying the percentage moves by 3.3, and so a 33% drawdown, more or less, is going to wipe you 100% out, right? So I know how much leverage I can take now. If this drawdown is 30%, I can take 2.8x leverage, and my risk won't be increased, because this is what I believe the trade will happen as. I'm willing to wreck that $1,000 in that trade, and I can trade with 2x leverage, which is going to stop me out at a 50% drawdown from here, which is around this level here. So that would be a 50% drawdown. My own stop loss is within this range. So by taking 2x leverage, am actually not increasing the volatility of the order whatsoever. I'm in, my own stop loss is here, and my 2x leverage that I can trade stops me out here. So I'm stopping myself out before the leverage. That gives me the opportunity to go in with leverage and potentially earn higher returns as we move up as well. Now, I can't recommend leverage. Don't trade with it, and do not trade anything that's unsuitable in your region or not allowed in your region, right? But for me, you can see here 2x leverage. That is what I would use. I know people go in with 5x leverage, 7x leverage, 10x leverage. What you're doing is just moving up the point at which you get liquidated on your stack. If you're using 10x leverage, it means that a 10% move to the downside is multiplied by 10, so that's a 100% move. So if you think the price is going to move down 10% from your entry, right, you are going to get liquidated in that trade. Now, the upside of that is that if you do catch one, you start to make very, very good money, right? Obviously things get multiplied by 10x, but that's not how we trade. 10x is way too much because this is a volatile asset class. So 2x leverage here on a drawdown, you're just playing the odds, but you're stopping yourself out before your leverage would liquidate your position. And so that's how to use it more intelligently. You can also use a position size calculator to tell you exactly how much you can trade with how much risk you want to take. So what we're going to do is go over to a position size calculator. You can look it up online. I'll link this one below. Bitcoin USD. And our open price was, let's say, around 65,000 for that trade. And our stop loss was around 40,000 for that trade. And we want to risk 10% of our balance. Now, again, you might see people saying 2 to 3%. That's 4x nonsense. Doesn't work in crypto. We have 7 or 8 opportunities, maybe in a bull market. We're not trading 4x. We're not trading pips like that. It just doesn't work in crypto. We're going to trade 10,000 over a cycle, maybe 10 trades or so. So, one trade each, 10%. We can trade 0.04 units of BTC. We go back and you can enter that in. On the right-hand side, you can click BTC here, and then you can put that amount in, and it tells you exactly how much you want to trade. Now, I know that drawdown is enough for me, right? So that 65 to 40 level, that would be a drawdown that's within my risk parameters. I'll just show you how that would work here. So I can actually switch this to USDT as well. So I know that I can put an amount in. So I'm going to put whatever amount in that you want to trade. And the drawdown, we know we need to put the stop loss in if we're trading on leverage. I'm using 2x leverage here. So what we're going to do is go to buy long with TPSL. Not going to put take profit in, but the stop loss was around 50% down, something like that. So as you can see here, this index, if I traded out at 80,000, that would be around a 45% loss. So let's put it on 88,000. You're looking at what, 30% loss there, right? So that's the stop loss that we're in. Now, if we're using 2x leverage is you get wrecked at 50% down. So if you're taking your stop loss underneath that, then you know that that leverage isn't making your own risk higher, because you've already said, I'm in at this level, I'm going to take my loss at that level, and that's it. Notice that I'm spending all my time talking about potential loss and stop loss. It's the only thing to worry about. People worry about profits and how much it's going to go up. All of that is irrelevant. This asset class is growing over time, so we just have to worry, if we're trading short term, about the risk that we have. The profits take care of themselves. So market order, I'll just show you to get this open here. So I'm using $100, so 2x leverage. That would be the stop loss. So I'm going to buy long, confirm, and that's in. Now you can see on Apex, you have your position and your stop loss here. Now you let the trade ride out. That's it. You can see here that we have this position open, right? And then if you want to, you can take profits over time. So what you can do is close by limit or market order. Assuming you know this, right, if you're looking at day trading, but market order is just trades immediately. Limit order is when you put the price that you want to trade at. You have to wait for the market to come and trade with you. So if I'm actually getting out of the position, that would be a sell. So I'd need someone to come and buy at that level for me. But what we're doing here is going to close this. So you can close by market and you can close an amount. So if you do want to take profits as the price moves up, right, and you think, this is a good time for maybe to, close this out, close this part of the trade out, you can do that, but you don't have to close the whole thing. You can close 50%, 25%, right, press confirm, and that will close out a portion of the order for you. What we can also do is look at these and drag them around. So you can drag this around and that actually changes the stop loss, right? If you want to do that, you can move it higher if you want, changes it around. So you know exactly what your potential loss is at all times, right? So you just have to make sure that this is within your leverage. So your leverage should not wreck you before you stop yourself out in that trade. So I'm going to market 100%. I'm going to close. So press confirm. That takes out both of those orders. Another reason traders would use leverage is not to take more risk in a trade. But back in the day when a lot of these centralized exchanges were popping up, going bust or whatever, using leverage on the exchange means you can just put less down on the exchange to trade with. And so if they do go belly up, you have more of your assets off the exchange. Now that's a little bit different with decentralized exchanges where you kind of don't have that risk. Now there are still risks because something can happen. You just never know, right? Something can happen with your wallet. But there's less risk there in terms of a centralized actor basically saying, I haven't got your money anymore, right? But when you use leverage in trades, that means that you can actually put less money down into the trade. And it means that you have more money to actually use, right? So you don't have, if you want to trade $10,000 worth, you don't have to put 10,000 into the trade. Maybe you only put $5,000, use 2x leverage, and you know that your stop loss is going to be there. That means you have your other $5,000 left, which means that you can use that to work for you. Again, I use Aave a lot. Now, Aave is a lending protocol. Aave has been through a couple of bear markets now, and it's held strong throughout the whole thing. So I use it a lot. And again, I can't recommend any app, and I don't want to. It's just what I do in terms of with crypto. With Aave, this is over collateralized lending, which means that people borrow on here, but they put more assets on than they can borrow. So if they want to borrow $100,000, they have to put $120,000 of the asset on there as collateral to borrow against. And that means that Aave, if they don't pay, can just sell their asset and pay back the lender. Now, if I'm lending USDC on here, people are paying me right now 20%. Now, I know that sounds high, and I know that I don't recommend the loaning out because we've seen all of those platforms go bust. This is DeFi though, like I said, and it's over collateralized lending. And during a bull market, these rates are very high. Now, the reason they're very high is because the crypto assets are going up actually more than that. Crypto assets are going up. I mean, like I said, in a bull market, it can go up 300, 400, 500%. So someone paying 20% in interest to go and long something that's going up much more than that. It's a good trade for them. But for us, if we're taking our trades anyway, we're using a bit of leverage here, we can put the cash to work somewhere else. So on base, USD coin is getting 20% right now, although this does fluctuate. So I'm going to go into here. You can see that the average yield is actually 10%. You can see that this is a floating rate market, so it can go high and low, but the average is getting 10% on your USDC here. If we go over to Arbitrum, which is another one, we're looking at 11% for USDC and 10% for Tether. So we can go in here, average is around 9.7%. So using leverage lets us take the trade that we want, but also keep cash back. And then we can put that to work in DeFi. We can put that to work in other positions. So for example, if we want to maybe go into some airdrops or something like that, or some other short-term opportunity, we have that cash to actually go ahead and do that rather than having it tied up in the exchange all the time. The other thing that you need to take into account, which no one ever talks about, is tax. If you live in a country with capital gains tax, crypto is deemed an asset in most regions, which means that you do have a tax liability when you trade it. Now that's different to Forex again, which if you're trading CFDs or something like that are non-taxable in various regions, right? This is a taxable event when you make profits, which means switching between cryptos can become a nightmare, which is again why I think less is more with crypto. Take your opportunities to get in and maybe sell out once during a cycle when you think the market is just a little bit topped out and you've kind of done what you came to do for that cycle. So once you take your profits there, it's going to be a lot easier to actually register that. It is a capital gain. Crypto is not Forex. And so you do have to keep that in mind. Now, there are many other strategies and I'll leave specific videos for those down in the description below. Too much for this video. Also, if you want to trade on Apex, 5% fee discount and a deposit bonus on there via the link and a few other links below on the exchanges and resources that I use. I'm James, this is MoneyZG. Cheers for watching and I'll see you in the next one.